Good morning, everybody. It's Al Ebaroa. It's Wednesday. It is May 16th. It is 2018. Today I am in Minneapolis, Minnesota. I'm just getting ready to walk out of my hotel room and head over to the Allianz headquarter campus. I'm going to spend the day there. Yesterday I flew in from our nation's capital, where I had the opportunity to welcome 187 World War II and Korean War veterans to the Capitol. Really an awesome tribute to these men that risked their lives for our freedom. So to all you servicemen that are watching out there, we thank you for your support and your continued effort for our country. Next, let's talk a little bit about what's going on in the Korean Peninsula. So if you're watching the news, of course you are, you recognize that the North Korean president has pulled away from the talks with the South Korean president amidst the turmoil of our military exercise with South Korea, and is actually threatening to not have the meeting with President Donald Trump. Now, here's what's really interesting. It's being blamed on this military exercise, yet a week ago, the North Korean president acknowledged it and recognized that this was going to happen and gave no indication that this is something that should be pulled, at least publicly. Now, what goes on behind the scenes, we have no idea. So this is a situation that I think is extremely unfortunate. If you follow me on Twitter, you know that I've shared my thoughts on that, and that I thought that we would have this great end to denuclearization on the continent, and that we would finally see some peace there. Well, doesn't look like that's going to happen, or it's just a game, right? Amazing development, an amazing, unfortunate development, I should say. By the way, if you're following me on Twitter at Al Ebaroa, I got a great clip of those of the veterans yesterday in our nation's capital. Have a peek, give me a follow if you'd like. Switch attention to the markets. So after 8 straight days of positive performance in the indices, yesterday we saw a rather substantial pullback. Now I say rather substantial. Okay, 190 points in the Dow, 18 in the S&P. This morning I've been watching Bloomberg, and we've been waffling back and forth steady, plus one stick, down a stick on the S&P, no big deal. So what's the problem? What happened yesterday? Well, number one, we had 8 straight days in the market. Okay, so the fact that we've had a pullback, that's fine. That's not an issue, right? It's actually probably healthy on the chart patterns. What's the blame? The blame is coming from the 10-year yields, right? So for the first time in a long time, we have seen 10 years print over 3%. 3.07 is where we're currently looking at right now. It's where we closed. I think we traded as high as 3.8 yesterday. I saw it waffling this morning around 306. Now, what's the relevance to us? Well, the relevance is a lot of mortgages are going to be tied into those yields, right? We haven't had an opportunity to get risk-free rates anywhere. And when I say risk-free, I really mean in this particular instance, I'm talking about govies, right? Backed by the full faith and credit of the United States government. Right now, the 3-year is yielding roughly 2% on an annualized basis, a little under that. So we haven't seen that in quite some time. You've had no opportunity to do that. So now we're going to see a little bit of competition from a marketplace that can be deemed lofty. I'm not suggesting that it is, but could be deemed lofty, switching to yield that's potentially risk-free in very short-term durations as a place to hide out. Now, why is it relevant on the 3-year again? Going back to that, well, that's going to affect things like dividend payers. It's going to affect things like real estate stocks. It's going to hurt utilities where people have been seeking those dividends. So that's going to put a little bit of pressure. Regarding earnings, we're wrapping up our earnings season. About 91% of the companies have already reported. And if we can continue at the current pace, 25% growth is what we will be looking at, versus the expected 17%, and that is a tremendous number. However, the caveat is 50 companies have already given some guidance for Q2 as to a little bit of pullback, versus only 36 saying, hey, we're going to do a great job. So over the next quarter or so, we're going to have to pay very close attention, as always, to price behavior and see if anything is developing. The price behavior that we saw last week in the market, I think, was great. I've been talking about leaks in the dam, so if you follow the channel, you know exactly what I mean. Well, those leaks in the dam, they started repairing themselves last week. The setups that we saw in the market, the sector participation, that is what we've been looking for, and we got it last week. So if we can continue that, that's going to be very good for the markets, despite the pullback in the macros, despite the fact that we're seeing some guidance, and despite the fact that we're seeing this spike in the yields. So keep your eyes glued to the charts. Remember, if you're trading options, stock and stock option trading involves a substantial degree of risk and is not suitable for all investors. And if you're like me and you like to watch those charts, guys, past performance is not necessarily indicative of future results. They're a gauge for us. Okay, remember that, please. I'm Eli Baroa, Financial Intelligence Training. You guys have a great day. Thanks very much.